In December 2008, one of the most respected names on Wall Street admitted that his investment business was built on fraud. Within hours, decades of reputation collapsed. Billions of dollars in client statements were revealed to be fiction. According to court documents, what investors believed were steady returns from legitimate trading turned out to be one of the largest Ponzi schemes in financial history. The man at the center of the case was Bernie Madoff. Before his arrest, Madoff was not an unknown operator working from the margins of finance. He had served as chairman of the Nasdaq stock market in the early 1990s and ran a brokerage firm that was widely regarded as reputable within the industry. His firm, Bernard L. Madoff Investment Securities, operated both as a market-making brokerage and as an investment advisory business. According to regulatory filings, the advisory side of the firm attracted wealthy individuals, charities, pension funds, and so-called feeder funds that directed large pools of capital to Madoff's management. The core attraction was consistency, according to investor statements later examined in court. Madoff's advisory business reported relatively steady positive returns, even during periods of broader market volatility, while other hedge funds experienced fluctuations. His reported performance appeared unusually stable, according to subsequent investigations. This consistency helped build trust. Many investors believed Madoff employed a split-strike conversion strategy involving options and blue-chip stocks. However, as later court documents showed, these trades were not actually executed at the scale reported. The growth of the business was gradual but persistent. By the early 2000s, billions of dollars had been entrusted to Madoff's firm. According to reports presented in subsequent proceedings, much of the capital flowed through feeder funds based in the United States and Europe. These intermediaries conducted their own due diligence. Though later regulatory reviews questioned the depth of those examinations, reputation played a central role. Madoff's long-standing presence in the financial industry, combined with his regulatory and exchange affiliations, reinforced perceptions of credibility. According to reports from former investors, many were introduced through personal networks, charitable organizations, and community connections. At the same time, oversight mechanisms existed. The U.S. Securities and Exchange Commission conducted examinations of Madoff's firm over the years. According to subsequent internal reviews by the SEC's Office of Inspector General, certain red flags were identified during earlier inquiries, but did not lead to the uncovering of the fraud at that time. Independent financial analysts also raised concerns. Most notably, investment professional Harry Marco Polo submitted complaints to the SEC beginning in the early 2000s, alleging that Madoff's reported returns were mathematically improbable. According to the SEC Inspector General's report released in 2009, these warnings were not fully pursued. Despite isolated skepticism, capital continued flowing into the firm. According to court filings, Madoff's advisory business operated with limited transparency. Client assets were reportedly held and custodied internally, rather than through independent third-party custodians. For many investors, however, consistent account statements and regular payouts reinforced confidence. The broader financial environment also contributed to the scheme's endurance. During the early and mid-2000s, global markets experienced strong growth. Investors sought stable returns with lower volatility. Madoff's reported performance appeared to meet that demand. However, according to later admissions in court, no large-scale options trading strategy existed behind the reported returns. Instead, investigators found that funds from new investors were used to pay redemption requests from earlier clients. Account statements were fabricated. Trading records were falsified. By 2008, the structure had grown vast. According to court documents filed during sentencing, the total amount of principal invested by clients was estimated in the tens of billions of dollars. The fictitious account balances reflected even larger amounts when including reported profits. The turning point came during the global financial crisis of 2008. As markets declined sharply, investors began requesting large withdrawals. According to court filings, Madoff was unable to meet redemption demands because the incoming capital that had sustained the scheme slowed dramatically. In December 2008, he informed close associates that the investment advisory business was a fraud. Federal authorities arrested him shortly thereafter. The collapse revealed not only the scale of financial losses, but also the extent of institutional trust placed in one individual and one firm. According to regulatory reviews and subsequent investigations, the scheme had operated for many years without detection. The rise of the Madoff enterprise was built on reputation, consistency, and confidence in oversight systems. Its fall would expose weaknesses not only in one firm, but in the broader regulatory environment. The next phase would examine how the Ponzi scheme functioned in detail, and why warning signs failed to stop it earlier. When federal investigators began examining Bernard L. Madoff investment securities in December 2008, they were not uncovering a complex derivative structure or hidden offshore vehicles. According to court documents and subsequent regulatory reviews, the advisory business operated as a classic Ponzi scheme. In a traditional Ponzi scheme, investor funds are not used to generate legitimate profits. Instead, money from new investors is used to pay returns to earlier investors. Account statements reflect fictitious gains, creating the appearance of steady performance, according to Madoff's plea allocution in federal court in 2009. This was the structure he admitted operating for years. Clients believed their funds were being invested in a split-strike conversion strategy involving large-cap stocks and options. According to reports and subsequent investigations, no such large-scale trading occurred. Instead, investigators found that trades listed on client statements were often backdated and fabricated to match favorable historical market prices. Court documents showed that the advisory operation was largely separate from the firm's legitimate market-making business. A small group of employees generated false account statements and trading confirmations, according to prosecutors. These records were produced internally without independent verification. One reason the scheme persisted was its outward simplicity. Investors received regular account statements showing modest but consistent returns. According to regulatory filings and court testimony, redemptions were generally honored, as long as incoming funds from new investors were sufficient to cover withdrawal requests. Another factor was exclusivity. According to reports from victims and court proceedings, access to the investment fund was often described as limited. Some investors reported that entry was by referral, reinforcing perceptions of select opportunity rather than mass marketing. Despite the steady returns, certain observers raised concerns. Harry Markopolos, an independent financial analyst, submitted complaints to the U.S. Securities and Exchange Commission beginning in the early 2000s. According to the SEC's Office of Inspector General report released in 2009, Markopolos argued that Madoff's reported returns were statistically improbable and inconsistent with the described trading strategy. The Inspector General's review later concluded that the SEC had missed multiple opportunities to uncover the fraud during prior examinations. According to that report, examiners failed to conduct sufficient verification of trading records and did not adequately follow up on the tail tips. Structural factors also contributed. Madoff's firm acted as its own custodian for client assets. According to regulatory analysis, the lack of an independent third-party custodian reduced external checks on account statements. Additionally, the auditing firm for the advisory business was a small accounting practice despite the scale of reported assets under management. In subsequent proceedings, investigators noted that the volume of options trading required to produce the reported returns would likely have been visible in broader market data. However, regulators did not perform comprehensive cross-checks against market activity during earlier reviews. By 2008, according to court filings, the advisory business had accumulated billions of dollars in principal from clients worldwide. When the global financial crisis intensified in the fall of that year, many investors sought liquidity. Redemption requests increased sharply. According to Madoff's own statements in court, he was unable to meet the surge in withdrawal demands because the scheme relied on continuous inflows of new capital. As market conditions deteriorated, new investments slowed. The financial structure that had operated for years became unsustainable. In December 2008, Madoff confessed to his sons that the advisory business was fraudulent. They alerted authorities. Federal agents arrested him shortly afterward. In March 2009, Madoff pleaded guilty to multiple federal charges, including securities fraud, wire fraud, and investment advisor fraud. According to court records, he admitted that the advisory business was a long-running Ponzi scheme. The revelation triggered immediate and widespread consequences. Charities, pension funds, universities, and individual investors reported substantial losses. According to estimates presented during sentencing, the amount of principal invested was approximately $17 billion, while fabricated account statements had reflected much higher balances. The scheme's duration and scale contributed to its notoriety. It operated through periods of market growth and decline. It involved global investors. It passed multiple regulatory reviews without being detected. The warning signs had existed. Mathematical improbability, concentration of control, limited transparency, yet they were not fully acted upon. The final phase of this story would focus on the legal consequences, the recovery process for victims, and the reforms that followed one of the most infamous financial frauds in modern history. After his arrest in December 2008, Bernie Madoff moved quickly through the federal court system. In March 2009, he pleaded guilty to multiple felony counts, including securities fraud, wire fraud, mail fraud, and perjury, according to court documents. He admitted that the investment advisory business had operated as a Ponzi scheme for many years. In June 2009, a federal judge sentenced him to 150 years in prison, according to sentencing records. The court considered the scale of financial harm and the duration of the scheme. Madoff did not contest the charges and did not go to trial, but the criminal conviction was only one part of the aftermath. The U.S. government appointed a trustee under the Securities Investor Protection Act to recover funds for victims. The trustee, Irving Picard, began a complex process of tracing money flows, pursuing clawback lawsuits, and negotiating settlements with feeder funds and financial institutions. According to court filings and public reports, billions of dollars have been recovered and distributed to victims over time. Although not all losses were fully restored, the recovery process focused on returning principal, the actual money invested, rather than the fictitious profits shown on account statements. In subsequent proceedings, courts ruled that investors were entitled to recover net losses rather than paper gains. That had never existed. The scheme's impact was global. Victims included retirees, charitable foundations, educational institutions, and financial intermediaries across the United States and Europe. According to reports from court filings and regulatory reviews, some charities were forced to close or significantly reduce operations due to losses. The U.S. Securities and Exchange Commission faced intense scrutiny. In 2009, the SEC's Office of Inspector General released a detailed report examining why earlier warnings had not led to enforcement action. According to that report, examiners failed to adequately investigate credible tips and did not sufficiently verify trading activity. As a result, the SEC implemented internal reforms. According to regulatory statements issued in subsequent years, the agency strengthened its enforcement division, enhanced whistleblower procedures, and improved risk assessment processes. In 2010, Congress passed the Dodd-Frank Act, which expanded whistleblower protections and enforcement tools for financial regulators. While Dodd-Frank addressed broader financial system risks following the 2008 crisis, the Madoff case influenced public and legislative attention on oversight failures. The case became infamous not only because of its size, but because of who was involved and how long it lasted. Madoff had been a respected figure in financial markets. He had served in leadership roles within NASDAQ and maintained long-standing industry relationships, according to reports and subsequent commentary. This reputation contributed to the trust that allowed the scheme to persist. The scale also set it apart. According to court records, approximately $17 billion in principal was invested by clients. The fictitious account balances were much higher. When including fabricated profits, few financial frauds had reached the level of sustained duration and global reach. Another factor was the simplicity of the scheme. There were no hidden offshore derivatives or complex hedge fund structures. According to Madoff's own admissions in court, he did not execute the trading strategy he described. Instead, funds from new investors were used to pay withdrawals and maintain the appearance of steady returns. The case also highlighted structural vulnerabilities in financial oversight. Concentrated control over custody, record-keeping, and trading created an environment with limited independent verification. According to regulatory reviews, reliance on reputation informal networks further reduced skepticism. In the years following the conviction, the trustees' recovery efforts continued. Settlements were reached with feeder funds and financial institutions that had directed client money to Madoff's firm. According to public reports, recovered funds have significantly reduced net losses for many victims. Though not completely eliminated them, Madoff remained in federal prison until his death in 2021. His case continues to be referenced in discussions of regulatory reform, investor due diligence, and white-collar crime enforcement. Why was it the most infamous Ponzi scheme? according to official records and market analysis. It combines several elements rarely seen together: extraordinary scale, long duration, global victim impact, regulatory oversight failures, and a perpetrator with deep ties to financial institutions. The story reshaped how investors, regulators, and financial professionals view trust and verification. It reinforced a basic principle often repeated in financial markets: consistent returns without transparent risk may warrant closer examination. For anyone studying financial history, the Madoff case stands as a cautionary example of how reputation can mask vulnerability and how oversight gaps can persist even within highly regulated environments. If you value fact-based investigations into major financial events and their consequences, consider following the channel for future documentaries.